The Federal Reserve expected to raise interest rates by another 75 basis points today, bringing the rate to the highest level since 2008 in an effort to fight and stomp out inflation. Fed Chair Jay Powell will speak today at 2:15, and then the press conference starts at 2:30 following that decision. Joining me right now is Amberwave Partners co-founder and portfolio manager Stephen Miran. And Stephen, it's great to have you this morning. Thanks so much for joining the conversation.
Thanks so much for having me. It's a pleasure to be here.
What do you expect from the Fed, and assess the macro story in the U.S. right now? I know you've got a global macro research department, but we want to look first at the U.S.
Sure. So the Fed is probably going to do 75 basis points today. This is a Fed that's had a really hard time forecasting inflation, and they know it. So they just take their cues from the bond market now, and the bond market's looking for 75.
What is that going to do to the economy? I mean, these are sharp, strong moves. Do you think we will be in recession next year?
You know what? We do think we're going to have a recession towards the end of the year, maybe the beginning of next year, and that's what we're telling our clients also. If you look at the historical context of Fed tightening cycles, on average, the median is about 3.3 percentage points, 330 basis points of Fed hikes until you get a recession. The market has priced 450 basis points, and then if you look at the balance sheet operations the Fed is doing, the taper they did, don't forget they were still buying bonds in March, and they tapered that to zero, right? As well as the quantitative tightening they're doing, allowing their balance sheet to roll down, that adds a significant portion on top. So the total amount of tightening the Fed's expected to deliver is probably closer to 700 basis points. That's twice the median cycle it's taken to induce a recession. So the chance of avoiding a recession, we think, is pretty small.
We were saying this yesterday, Dagan, that the fact that the Fed was buying $120 billion in securities every month they're at 21, and all the way up until they raised rates in March.
Right, but investors have gotten used to being bailed out by the Fed and having their gambling juice to the high heavens. And that's what happened during the summer, is when the market started rallying, the whole bet was, housing's going to get a little weak, and the Fed is going to blink. And they were already talking about when the Fed was going to start cutting rates toward the beginning of next year. And clearly what Jay Powell saw was, wait a minute. And one of the, we need to send the message that we will accept a recession in order to fight inflation. And the markets, investors misread it. And the biggest problem right now is the Fed needs to reduce euphoria in the markets, but also among consumers. And that's increasingly difficult because Jay Powell has lost faith and confidence. He's tough and diligent against inflation. So he's boxed into this conundrum. Oh, and by the way, yesterday, GDP now, the Atlanta Fed. So we're already in a recession, contraction, first quarter, second quarter. The third quarter from the Atlanta Fed is at 0.3% growth for the third quarter.
Yeah, we're already in a recession. I agree with that.
So I think that what Dagan said is exactly right, that investors are used to being bailed out by the Fed. You've got 2-3 decades of policy, monetary, fiscal, everything, pushing volatility down anytime it sprung up. Don't forget, the pandemic was the biggest economic shock we'd had in, since the Great Depression. And that recession lasted only a few months, right? It was only a few months until the economy was creating jobs and starting to restore the jobs that we'd lost to COVID. And that was because of the huge policy actions that we took when we were at Treasury and that the Fed took as well. So investors are used to that. But now things have switched. And for the first time in decades, policy isn't pushing volatility down. Policy is driving volatility higher, right? And that's going to stay that way for a long time. And it's not just monetary and fiscal policy. It's volatility on the supply side as well. It's what's going on, with a land war in Europe, right? Potentially a war in Asia, continued supply chain disruptions from places like China, right? All these things are driving volatility higher, and it's going to stay that way.
But can I just add one quick thing? But in terms of the supply side, the speculation and the gambling that has been encouraged by the Federal Reserve for at least 2 decades, that leads to unproductive behavior. Like people thinking they're going to working in crypto or betting on crypto, even the Peloton culture. That is unproductive behavior, and it's reminiscent of the late 1920s.
They've done this over and over again at the Fed,
Absolutely. I think that there's lots of...
I didn't mean to interrupt you.
That's good.
Oh, sorry.
You got it. You go
I think
for it.
There's lots of liberal economists that will say something like, the inflation is all driven by the supply side, so you can't blame bad fiscal policy, you can't blame bad monetary policy. I think that's a bit misguided because the supply side isn't driven purely by things that are totally random outside the U.S. You had exactly what you said, you had an environment in which crypto prices, stock prices were going up into these crazy bubbles, and people said, why would I work more? Why would I get a job? I can just stay home and trade crypto and trade GameStop and AMC. And so I'm not going to work a little bit more, right? And that was a supply side inflation, but it was driven by policy.
But how about these mortgage rates, just really quickly? I mean, I'm looking at this. I bought a home last year. I'm watching the rates people are paying now. I think we're underestimating how big of an impact that could have on consumers going into next year. To me, that's where the depth of the recession really starts to look like a risk.
We've seen demand destruction in housing. I mean, look at the housing starts, how they've plummeted.
Yeah.
Oh, absolutely. And it's crucial to remember that housing is the key transmission mechanism that the Fed uses to control inflation. And like when you buy a home, it's not just that you're buying a home. You're probably buying a car, a lawnmower, investing in landscaping, furniture, paint. Yeah. There's all sorts of stuff that you spend money on when you buy a home. And when the the mortgage payment on a median home goes up 50-60% over the start of last year because of higher prices and higher interest rates, that's dampening on housing.
But that was unfortunately, you're getting sticker shock when you go to rent as well. Real quick before you go, we talk so much about ESG because this administration has an all-of-government approach in terms of pushing its climate agenda. You've come up with JSG. What is that?
So we do what we call JSG Investing, which stands for Jobs, Security, and Growth. And so we think that those are factors that you look at that are going to drive long-term shareholder performance, long-term stock performance, as well as being good for America and investing in America. And many of these same macro currents that are driving volatility are driving companies to reshore activity, to invest in supply chain resilience, to invest in making sure their supply chains are at home in America and not exposed to China, not taking your money, sending it to China, creating jobs there, but creating an environment where you're going to be more resilient to downside shocks. And we think that drives long-term shareholder performance.
I love the idea, especially with all of this talk about ESG and this bullying of all of these money managers to get on this ESG board. By the way, at the end of 2020, you and Treasury Secretary Mnuchin canceled certain programs. He saw the end of the emergency at the end of 2020, right? What are the programs you canceled?
So we canceled the Federal Reserve facilities, right? Treasury withdrew its capital allocation that allowed the Federal Reserve to basically buy fixed income securities across the spectrum that we thought it didn't need. We thought that the pandemic emergency was ending, that vaccines were around the corner, that the economy would be reopening on its own. And
the Fed didn't see it that way. They kept buying.
But those programs were written by Congress to expire, so they expired.
Yes,
they were expiring, and you chose not to extend them.
Yes. So Treasury gave capital to the Federal Reserve to allow it to buy, bonds, everything from, asset-backed securities to municipal bonds or something, right? And so there was the view that the recession was ending on its own because vaccines were going to allow reopening to occur, which is what happened.
No.
And that it was time to sort of pull back some of these emergency stances and step back from a crazy emergency, loosest policy in history.
My point is they saw the emergency ending. The Federal Reserve did not. The Federal Reserve kept buying every month in 2021. I think it's important that you did not re-up those programs and you stopped those programs at the end of 2020.
But the president, they were
thinking the economy was in a shambles, and it started booming in the middle of 2020.
Yeah.
Exactly. It was the worst possible timing to hit the fiscal accelerator.
And that's what they did. Exactly. Stephen, great to have your insight.